Hello everybody, I hope you can hear me well, and welcome to the second in our series of Working in Australia webinars. Today predominantly we're going to focus on a fringe benefits tax update because it's the time of year where that is most relevant to lots of you and lots of us, so we thought it made sense to cover that off. We're also going to cover a hot topic that we covered last time a little bit, actually related to individuals who are sort of stuck in Australia from a tax perspective. And that's in response to feedback we received after the last session that it seems to impact quite a few people. So we thought we'd spend a few minutes on that as well. In terms of housekeeping, hopefully the technology is working well for you. As you heard, you're in listen-only mode, so we can't hear you. There is, however, a chat function that you can use. So what we're going to invite is at any point during the session, if you've got relevant questions, please put them into the chat function, and we will do our best to filter them and answer them at the end. Or if we can't do that given time, we'll take them on notice and get back to you. If you have connectivity issues, I'm told the best thing to do is to treat this as a phone call, and that speeds things up. You can see there's a little bit of information there. For everybody that registered, once we are done with this session, once it's completed, a recording will be available, as it will be to past webinars. You will also get our contact details and the material that we have as well. What I'm going to do now, excuse me, my phone is ringing. I'm not sure if you can hear that. I don't have to stop, but please excuse me 1 second. There we go. Sorry about that. What I'm going to do now really quickly is introduce the content that we want to cover. I mentioned predominantly what we're going to do is an FBT update, but with a little piece of a little interesting piece, I think, about employees working temporarily in Australia before we jump into FBT from a COVID perspective, and also more broadly a technical update given the season, as I mentioned. I'd also like to introduce the speakers for today. So I think you can probably see everybody on your screen, but there's also a slide there now that you should be able to see as well. We've got James Traynor, who's a fantastic partner in our Sydney practice who specialises in employment taxes. Myself, who some of you know, I'm introducing rather than presenting today. I lead our expat and employment tax practice. I'm part of my members of my team here. You can see Nadine and Steph as well, who are fantastic senior managers from my team, who are really excited to be presenting to you today, and also really excited as we roll into the FBT season for the year, I can assure you. So I think with that, I'm handing over to Nadine in the first instance to take us through the first piece. As I mentioned, any questions as we go, please flag them with us. We'd love to try and take care of them either here and now at the end or afterwards. And we're looking forward to a really good session. Thank you.
Perfect. Thank you, Ben. And hi, everybody. So I think we can all agree that the COVID-19 pandemic has brought along with it a set of very interesting challenges. And some of these challenges that have been faced include people either stuck in Australia or those who have returned to Australia for health safety reasons or to be with family during these uncertain times. And this, no doubt, creates a lot of questions and concerns for the employers of these individuals, and whether or not their employees' presence in Australia gives rise to employer tax obligations for them as the employer. During the early stages of the pandemic, the ATO released guidelines stating that where an individual was stuck in Australia purely due to COVID-19, they wouldn't necessarily become a tax resident if they usually live overseas permanently and intend to return to their home country as soon as they were able to. These guidelines applied up until 30 June 2020. And they've actually been evolved, and the ATO is not as lenient as it used to be. If we consider the ATO's guidance at the start of the pandemic, versus what we see now, the ATO is definitely less generous as what it used to be. The ATO now says that if one ends up staying in Australia for a lengthy period and does not plan to return as soon as they're able to, they definitely need to review their tax residency status and assess each based on its merits on a case-by-case basis. Next slide, please, James. So I think I might run a poll at this point and just ask you to please answer yes or no to the question. Do you have any employees either stuck in Australia or who have returned to Australia for safety reasons or to be with family during the COVID-19 pandemic? So we'll just wait a few minutes just to tally up your votes, just out of interest to see how many of you are actually affected by this. But what I would say is, for those who do find yourself in this situation, and certainly with the less generous ATO guidance, we strongly suggest that you seriously consider your employee's tax residency status, and how this might impact you as the employer. We think you're a bit unsure of the situation. Oh, sorry, and there's just the poll results quickly. Okay, so not many of you are affected. Okay, perfect, only 14%. Okay, that's fine. So essentially, as I said, if you do find yourself in this position or in this situation where you do have employees, definitely consider it, because it definitely could affect you as the employer. And if you are unsure of the situation and how it might affect you, reach out to us. We can definitely help you with that. Or alternatively, you can go directly to the ATO to get a ruling request. However, bear in mind that we have noticed that the ATO's processing times has been delayed. It has actually been considerably delayed due to the increase in volume requests for these rulings, as you can imagine. Then moving on, if your employee is a foreign resident, and they would typically only be taxed in Australia, well, actually, they would only be taxed in Australia on Australian sourced income. Broadly, employment income is sourced in the country where the work is physically performed. If your employee is in Australia due to COVID-19, they're likely to either be working remotely or they'll likely be on paid or annual or holiday leave. The ATO guidance states that if your employee is a foreign resident and they are on annual or holiday leave since being in Australia, the income they receive for this leave period will not be Australian sourced and will therefore not be taxable in Australia. On the other hand, where your employee is working remotely in Australia and is continuing the foreign employment, you would need to consider whether the income is from an Australian source and whether or not a double tax treaty is in place in between Australia and that individual's home country. However, specifically for COVID-19 reasons, the ATO has said that if your employee is continuing their foreign employment remotely in Australia for less than 3 months, they will straight away accept that the income would not be taxable in Australia. For any period longer than 3 months, the ATO will still accept that the income is not Australian sourced if the only thing that has changed is that the employee is now working remotely in Australia due to COVID-19. The employee intends to leave Australia as soon as they are able to, and there's no other connection to Australia. Now, what does it mean to have a connection with Australia? You'd need to consider the following factors, and you need to examine them to determine if there is a connection to Australia. So you'd need to look at the nature of the employee's job and whether or not the terms and conditions of their employment contract has changed, whether or not your employee starts performing work for your Australian entity if you have one, if the economic impact of your employee's work shifts to Australia, who your employee's economic employer is for the period that they are in Australia, the extent of work your employee performs for Australian clients, whether your employee's work is significantly dependent on your employee being physically in Australia, whether or not Australia becomes your employee's permanent place of work, and lastly, whether your employee's intention towards Australia changes. This is all relevant because where an employee has a tax obligation in Australia, they create corresponding employer tax obligations for you as the employer. Amongst these is pay-as-you-go obligations, superannuation, payroll tax, workers' compensation, and fringe benefits tax. Briefly, for a foreign employer to meet its pay-as-you-go obligations, it would need to either register for a tax file number or a withholder payer number, or alternatively, it can run a shadow payroll through its local Australian entity to facilitate the remission of the pay-as-you-go to the ATO. Regarding superannuation, employers of most employees working in Australia are required to contribute to superannuation on behalf of their employees. Now, there is a mismatch between the Australia's double tax treaties and the Superannuation Guarantee Act, whereby if your employee's employment income is exempt from income tax in Australia under the treaty, it doesn't necessarily exempt the employer from having to make superannuation contributions. The only way in which an employer will be exempt from superannuation is if there is a bilateral social security agreement in place between Australia and your employee's home country, or if your employee is considered a prescribed person as defined in the Superannuation Guarantee Act. For payroll tax purposes, payroll tax will be due on your employee's salary and wages if your wage bill is above the threshold in the applicable state. But be aware of grouping provisions that may apply when you consider if your wage bill exceeds the relevant threshold. You'll also be liable for workers' compensation, and you'll need to contribute to workers' compensation on your employee's behalf. And then finally, be aware of any non-cash benefits provided to your employees or their associates, as this will likely give rise to potential FBT implications, which is the main focus of today's webinar. And with that in mind, I will now hand over to my colleague, Steph, who will take you through some of the common fringe benefits and COVID-19.
Thank you, Nadine. I hope everyone can hear me well, and welcome again to our webinar, FBT webinar. Due to the widespread pandemic impact of the COVID pandemic, many employers needed to provide different kinds of benefits to their employees this FBT year. We saw less entertainment and more working from home equipment being provided. The potential new benefit categories for your organisation and the interpretive approaches to benefit valuation will also need to be considered. It will be critical for the FBT return preparers to undertake some investigation to ensure that all new benefits are identified and considered this FBT year. So let's now look at some of the common fringe benefits that may be provided by employers during an FBT year, and we'll begin with expense payment fringe benefits. So an expense payment fringe benefit can occur when the employer reimburses an employee for expenses they have incurred, or when the employer pays a third party in satisfaction of expenses incurred by the employee. A key element is that the payment obligation must belong to the recipient, and expense payment fringe benefits often include things like business-related expenses, and substantiation requirements must usually be met to avoid paying any extra FBT. The taxable value is generally the amount of the payment or reimbursement by the employer, less any employee contributions. So now let's look at some common examples of expense payments. So they include things like utilities such as gas and electricity, flights such as home leave flights, health insurance, visa or citizenship expenses, accommodation expenses including rent, leasing of furniture or storage spaces, education expenses, and meals and tickets in entertainment items. So now let's move on to our second poll question for today, and the following question will be asked. So during COVID, did you provide your employees with computer monitors, chairs, or other office equipment whilst working from home? So all you have to do is answer yes or no to this question. I'm curious to see the percentage that relates to either or answer. And in the meantime, while everyone is answering that question, I'll talk about some exemptions and reductions in relation to expense payment fringe benefits. And they include the otherwise deductible rule, exempt accommodation expense payment benefits, and exempt car payment benefits. So the results are in, and 76% of you said yes, you did provide your employees with computer monitors, chairs, or other office equipment whilst working from home. What a surprise. So following on from the poll question, we'll move on to some things that may be of interest. So items that exempt from FBT are as follows. Eligible work-related items such as laptops, portable printers, portable electronic devices, emergency assistance such as accommodation, food and drink, returning employee in quarantine or having to self-isolate. So they're things such as flights back to Australia, temporary accommodation or quarantine costs. Stranded FIFO DIDO workers, for example, temporary accommodation and meals for interstate FIFO workers that are trapped out of their home state, which may have occurred during the FBT year, and other work-related preventative health care. So the minor benefits and the otherwise deductible rule may apply to things like computer monitors. So I'm, like everyone else, working from home. As you can probably hear, the doorbell just rang. And computer monitors that are under $300, where they're minor and infrequent in use, will apply. The use of company-owned office equipment during COVID period, but they must be returned to the employer, and reimbursement of business portion of home internet telephone expenses and the like. The ATO has also provided guidance on a number of other COVID-related scenarios, and they include cancelled events. So you will not have to pay FBT if you are required to pay non-refundable costs for cancelled events your employees were due to attend. This is because the arrangement was between you and the event organisers, not the employees, and you have not provided any fringe benefits to your employees as they didn't attend the event. However, you may have to provide FBT if your employees were required to pay for their attendance at the cancelled event and you reimburse them. So this would be an expense payment fringe benefit unless the otherwise deductible rule applies. Following from that, also protective clothing. So if you provided your employees with items to help them protect them from contracting COVID-19 whilst at work, and they're things such as gloves or masks, hand sanitizers. These benefits are all exempt from FBT under the emergency assistance exemption. The conditions, though, that must be met, so they are employees who have physical contact with or are in close proximity to customers or clients while carrying out their duties of employment. So, or if they're involved with like cleaning premises, for instance. So they're primarily workers in the medical, cleaning and retail space. COVID-19 testing. So you will also not have to pay FBT for providing COVID testing to employees if both of the following apply. So testing is carried out by a legally qualified medical practitioner or nurse, and testing is available to all employees. So as all employees are equally susceptible to contracting the COVID virus, it qualifies for the FBT exemption for work-related medical screening. If only some of your employees, though, get tested for COVID, it can still be exempt from FBT as long as the testing is offered to all employees. So now let's talk about the no private use exemption that you can see on your screen, and that applies in circumstances where there is ongoing use of company-owned office equipment after the COVID period to support an employee working from home. The company has consistently enforced a policy of no private use, and the employer makes a no private use declaration and keeps it on file. FBT will apply though in circumstances where you reimburse or provide home office equipment, for example, a chair where the value is over $300 GST inclusive. The minor and infrequent rule doesn't apply to items over 300, as we all know. The otherwise deductible rule doesn't apply, and there is no once only deduction. And also it doesn't apply where the private use of company-owned office equipment is allowed. So we'll now touch on the topic of car fringe benefits and also car parking fringe benefits, and including some COVID-related scenarios. So generally speaking, a car fringe benefit will commonly arise when a car which is held by an employer, an associate of an employer, or under an arrangement by the employer is made available to employees for any private use. So the following types of vehicles are cars under the FBT Act. So a motor car, station wagon, four-wheel drive vehicles, panel vans and utilities, all other goods carrying type vehicles designed to carry less than 1 tonne, all other passenger carrying type vehicles designed to carry fewer than 9 occupants. They are not motorcycle or similar type of vehicle. For FBT purposes, cars exclude panel vans and utilities designed to carry a load of 1 tonne or more. So what does held by a provider mean, and who is the provider? So held by provider is satisfied when the car is either leased by the provider being the employer or associate of the employer, owned by the provider, or obtained by the provider under a novated lease arrangement. And what does available for private use mean? What does it actually mean? A car that is allocated to an employee is available for private use where it is actually used for private purposes, and also where it is deemed or taken to be available for private use of an employee on any day where the car is garaged at or near the employee's residence, or the car is not on the employee's business premises and the employer either has entitlement to use the car for private purposes, or the employee has custody or control of the car outside of working hours, even though the employee may not be in the same location as the car. So we'll move along now to just touch on the taxable value under the stat formula method and the operating cost method. So as many of you may know, the taxable value under the stat formula method is 20% times the base value of the car times the number of days available for private use. The base value is the original cost price of the vehicle, including GST, luxury car tax, dealer delivery charges, excludes registration and stamp duty, plus any non-business accessories. And then the cost price is the expenditure incurred to acquire the car, reduced by trade-in discounts and rebates. The base value is reduced by a third after 4 years, as we all know, and less any employee contribution. The stat formula method is the default method, unless the operating cost is elected for the car in that year. You can most certainly change year on year as well between stat formula and operating cost. So let's take a look at the operating cost method. So the taxable value of under the operating cost method is the total operating costs times the percentage of private use. The operating costs include actual costs such as fuel, registration, insurance, repairs, lease payments, and deemed costs such as interest and depreciation. You will need an employee logbook to substantiate the private use of the vehicle, and you take away any employee contributions. So generally, when the car fringe benefit is provided under a novated lease arrangement, the lease provider will calculate the taxable value of benefits provided during the year. If a company provides car fringe benefits via novated lease arrangement, the lease providers generally would give the company a summary of the FBT calculations for benefits provided, applying the statutory formula method. We, BDO, would normally review these calcs during an FBT review, therefore there is no need for you guys to perform any additional work. Many arrangements include a post-tax employee contribution, which may help reduce the FBT taxable value to nil, so no FBT liability arises. For cars returned to the employer's business premises, generally you won't provide a car fringe benefit where a car is not applied for your employee's private use or taken to be available for your employee's private use. During a period of COVID restrictions, a car that you've provided to your employee is not taken to be available for your employee's private use if all of the following apply. The car is returned to your business premises, your employee cannot gain access to the car, and your employee has relinquished an entitlement to use your car for private purposes. So some factors that indicate a car is not taken to be available for your employee's private use during these restrictions may include, for example, where the employee does not have physical access to the car, or you consistently enforce a policy that your employee cannot gain access to the car. For a home garaged car, you can use the operating cost method to reduce your FBT liability. If the car is not being driven, you will need odometer records to substantiate nil taxable value. If the car is being driven, then you will need logbooks to substantiate the business use percentage. FBT applies if you are using the stat formula method. Now, in terms of logbooks, you can rely on existing logbooks. You can make a reasonable estimate of business use in the current FBT year. You can use new logbooks where the business use percentage is impacted by COVID-19, and you can adjust the estimate for business use percentage if 2021 is a logbook year. So also affected by the pandemic are employee driving patterns and parking patterns. As you may all know, as you can see, there's a lot less people in the city and in car parking locations around the city. So as a result, the ATO has released a specific fact sheet which covers what happens if your employees have been garaging work cars at their homes due to the impacts of COVID-19. It also covers the concessional approach to scenarios where a car is being home garaged but isn't being driven at all, or is only being driven for maintenance purposes, and whether prior year logbooks can remain valid for the current year, and whether current year logbooks are also representative. So additionally, the ATO have updated their guidance on how to assess the impact of COVID on car parking fringe benefits. So this guidance, it outlines whether a car parking benefit would arise if your office is closed, and the impact of the closure or reduced rates at a nearby commercial car parking station, which is what we're going to talk about quickly now. So in circumstances where there are car parking closures, there is no benefit if the car park is closed on a day, as you will not have provided a car parking benefit, as there'll be no car space available for use by your employee for more than 4 hours between 7 a.m. and 7 p.m. on that day. The time during which the work car park is closed will not form part of the availability periods used to calculate the taxable value of the car space under the stat method. Similarly, if all of the commercial car parking stations within a 1 kilometre radius of your business premises are closed on a particular day due to COVID, there will be no car parking benefits provided. In terms of the reduced commercial car parking rates, there is also no benefit if all commercial car parking stations within 1 kilometre radius charge less than the $9.15 for all day parking on 1 April 2020, provided the rate is representative. So that means that where all the car parking stations within the area have discounted their all day parking rate due to COVID. There are likely to be lower rates generally, so car parking valuations may be beneficial. Under the actual method, there is a potential to save FBT if you keep records of car parking use. So now let's move on to residual fringe benefits. And let's start with what is a residual fringe benefit. So it is any right, privilege, service or facility provided in respect of employment. For example, the provision of insurance coverage, general services such as hire cars, gas and electricity, facilities such as a holiday house. A supply of goods integral to services are both determined to be residual fringe benefits. Essentially, a benefit is considered a residual fringe benefit if it does not fit to any specific category of fringe benefits. So residual fringe benefits, they're often difficult to identify. So we do recommend that you have details of specific recipients that are maintained on file. In-house residual fringe benefits are provided when the employer is provided with a benefit that is identical or similar to items that you sell in the ordinary course of your business. So the value of the benefit for FBT purposes is dependent on whether you manufacture, produce, or acquire the item. For in-house residual fringe benefits, where no identical benefits are provided to the public, the taxable value is 75% of the amount the employee could be expected to pay to acquire the benefit under an arm's length transaction, less any amount paid by the employee, of course. The taxable value of an external residual fringe benefit is generally where the employer purchases the service, right, or privilege under an arm's length transaction, less any employee contributions. So now let's move on to some common examples of residual fringe benefits, and they may include things like use of company motor vehicle other than a car, use of company housing, use of company computer equipment or office furniture, which may certainly well be the case during COVID periods, employee beneficiary of company insurance policy, free or discounted services to employees, childcare, gyms and other recreational facilities. Now, in terms of any exemptions and reductions that may apply to residual fringe benefits, they may include the otherwise deductible rule. So for example, where you had a situation during COVID for office equipment that you loan to an employee to support a working from home arrangement, that will constitute that will continue, on a long-term basis, the taxable value of that benefit may be reduced under the otherwise deductible rule. The otherwise deductible rule applies if your employee would have received a once-only deduction had they incurred the expenditure themselves to rent the equipment solely to use for work purposes. If the otherwise deductible rule applies, the taxable value of the benefit is reduced by the gross amount that your employee would otherwise have been allowed to deduct had they incurred the expenditure themselves, less the value of any employee contributions. Non-private use of motor vehicle other than a car, recreational facilities on employees' business premises, childcare facilities on employees' business premises, FIFO transport, remote area housing, transport and use of property located on employees' business premises is another reduction. So now moving on to living away from home allowances. And what is a living away from home allowance? or otherwise known as LAFA. So a LAFA is an allowance paid by an employer in respect of the employment of that employee due to the employee being required to live away from home in order to perform his or her duties of employment. It is an allowance paid by an employer to an employee to compensate for additional expenses incurred whilst living away from home and disadvantages, if any, suffered due to the requirements of their role. Typically, allowances that are considered a LAFA include accommodation as well as food or drink. The ATO generally accept that an amount is a LAFA when the requirement to work away from the employee's usual residence is for a short duration and is temporary in nature. A LAFA is generally the only allowance that is considered to be a fringe benefit. All other allowances are considered to be salary and wages of an employee. And the taxable value of a LAFA is the amount of the allowance. Now, in terms of exemptions and reductions, the taxable value of a LAFA can certainly be reduced by the exempt accommodation component. What is that? It's any part of the allowance that is a reasonable compensation for the cost of accommodation of the employee plus family at or near the employee's workplace, and or any part of the allowance that is reasonable compensation for additional expenditure on food. Now, note that where the total food and drink expenses for an employee exceed the amount the Commissioner considers as reasonable, the expenses have to be substantiated under Section 31G of the FBT Act. We'll move on to the concession conditions for LAFA. Just to have a quick recap, so they are where the employee maintains a home in Australia, which is their normal place of residence and remains available for their immediate use and enjoyment whilst they are living away from home. They're able to substantiate all expenses incurred on accommodation and food if the food or drink is more than the Commissioner's reasonable amounts. Provide the employer with a declaration about LAFA and where required a declaration on substantiation. Now, the fringe benefit relates only to the first 12-month period at a particular work location. So now we'll quickly take a look at an example which illustrates how the exempt accommodation component may apply. So we have Helen, who receives a LAFA from her employer, which includes an accommodation component of $450 while she's gone to Sydney for 6 months. Her normal residence is in Melbourne, and her Melbourne home continues to be available for her immediate use during her secondment. Helen resides with her husband Jim, who rents a house in Sydney for 6 months at a cost of $450 a week. So the exempt accommodation in this case is $450, provided that substantiation requirements are met, and it's obviously exempt only for the first 12 months. Moving on to just a little table which outlines where the company pays an allowance that is for additional food costs and is less than or equal to the Commissioner's reasonable food amounts, then no substantiation is required and the taxable value of the food component is nil. Where the company pays for additional food costs and is more than the Commissioner's reasonable food amount, then the substantiation provisions under Section 31G of the FBT Act will apply. The taxable value is the difference between the allowance paid and the Commissioner's reasonable food amount. Moving along to entertainment. Moving along, I can see the questions are pouring in. Moving along to entertainment. So indeed, due to the impacts of COVID-19 and continued restrictions, many businesses considered providing alternate entertainment benefits compared to what they traditionally provided, particularly during the Christmas period that just passed us. I know BDO did as well. You may have included gifts, gift cards, hampers and vouchers rather than Christmas get-togethers or more formal functions due to the inherent restrictions. So what is entertainment? Entertainment is not a separate fringe benefit. It is food, drink, and recreational entertainment. It includes travel and accommodation associated with entertainment. How is the taxable value determined? It is determined by expense payments, property, or residual benefits under the actual method. Alternatively, the employer can make an annual meal entertainment election under the 50-50 split method. Some exemptions and reductions that may apply include food and drink, which is not entertainment, for example, sustenance, meals whilst travelling for work, and food and drink consumed on the employer's business premises under the actual method, of course, only. So the following table, as you can see, provides an overview of some of the common factors in determining what constitutes entertainment. So some questions or factors that are included are: why is the food or drink provided? What food or drink is provided? When it is provided? Where it is provided? So if we have food or drink that is provided for refreshment purposes only, then it is less likely to be entertainment. If it's provided more in a social situation, then it is more likely to be entertainment. If the food is morning tea and afternoon tea or light meals, it is less likely to be entertainment. If there are more elaborate meals or if alcohol is involved, then it is more likely to be entertainment. If the food or drink is provided during work hours or overtime or while the employee is traveling, then it is less likely to be entertainment. But if it is provided during a social function, it is more likely to be entertainment. If the food or drink provided is at the employee's business premises or at the usual place of work of the employee, then it is, of course, less likely to be entertainment. However, if it is at a social function, hotel, restaurant, cafe, coffee shop, restaurant, etc., then it is more likely to be entertainment. So special rules apply to tax-exempt body entertainment, and they are those who are partially or wholly exempt from income tax and those that provide non-deductible entertainment. Now, let's take a look at the actual versus 50-50 method and which method might be more beneficial, especially during COVID scenarios. So consider whether the actual method will result in a lower FBT liability. It may be lesser effort with fewer transactions this year due to the non-entertainment events during COVID periods. There is greater scope for the minor and infrequent exemption to apply for items that are less than $300 in value. And also no FBT applies if your deposit was lost for employer arranged cancelled events, which was also touched on earlier. Now, finally, let's take a look at the non-for-profit salary packaging. So you may provide salary packaged meal entertainment to your employees to take advantage of an exempt or rebatable cap. Arrangements to provide meals may qualify as salary packaged meal entertainment depending on the facts and circumstances of the meal and how the meal is provided. Given the unprecedented circumstances brought about by COVID, the ATO has said that they will not apply compliance resources to scrutinise expenditure under these circumstances. For the FBT year ending 31 March 2021, when meals are provided by a supplier that was authorised as a meal entertainment provider as at 1 March 2020, and for the FBT year ended 31 March 2020, when restaurants and public venues were closed. So our partner now, James Trainer, will now discuss the relevant tax technical FBT updates for 2021. And thank you all very much for listening and for your valuable time.
Thanks very much, Steph. So I'm going to run through some of the updates that have happened to FBT during the last 12 months, and also some of the announcements that came through in the budget where there might be some changes to the FBT rules and practice going forward. So we've had some updates to the rates, and we've also just in the last week had an announcement of some rates for the following FBT year, for the year starting on the 1st of April 2021. So the benchmark interest rate is currently 4.8%, that's dropping to 4.52%, and that applies where an employer is providing an interest-free or a below market interest rate to employees, and that will help determine whether there's an FBT liability. The car parking threshold is $9.15 this year. So if there's a commercial car park that's providing or charging more than $9.15 for all-day car parking within the 1K radius, then you're going to have to consider whether you're providing a car parking fringe benefit. We're waiting for the rate for next year to come through. The motor vehicle cents per kilometre rates are the same this year and next year, and those rates are there. And there's also a slight increase in the record keeping exemption threshold for employers who don't provide too much in the way of fringe benefits. So what are some of the changes that we've had in the last 12 months? Well, finally, we had a change to the definition of taxi, and now we are pleased to say that ride-sharing services are a taxi service, and they are now exempt from FBT where the employee travels between home and work. And that might be travel on any particular day that they're working. It also might be if they're sick or injured and they need to go home, or perhaps to a hospital or something like that. If they jump in an Uber, then that is also exempt from FBT now. In relation to car parking, we still have a very unsatisfactory position where the rules still have not been clarified. There was a draft ruling that was released in 2019, and that is still under consideration. So the ATO has sought some further consultation and is still deciding on what is the definition of a commercial car park. Unfortunately, we expect that the ruling will not back away from the position that was taken in the draft ruling, in that a commercial car park can include a shopping centre or hospital car park that provides or charges a penalty rate for all-day parking. The ATO is firm in the view that the case law supports them, that is still a commercial car park, so that will impact employers who might be in some of the business parks outside of the CBD. The ATO is looking to provide a little bit more guidance to help work out when a third party is operating a commercial car park. So one of the crazy requirements in the FBT rules is that you, the employer, need to work out whether a third party is operating a commercial car park. You need to put yourselves in their shoes and work out, are they running it commercially? So the ATO is giving a little bit further guidance as to some objective factors that might be considered, and so you don't actually need to put yourself too much in the mind of that third party. The intention is that this will apply from the 1st of April 2021, so it is not that far off, but yet we still don't have a final ruling. So again, a very unsatisfactory situation, but the ATO tells us the release of that ruling is imminent. The long-running saga around transport and travel expenses has been partially resolved. In relation to transport expenses, the ATO has issued a final tax ruling 2021/1, and this ruling covers when transport expenses are deductible for income tax purposes, and as we know, that then flows to whether those benefits which are provided by the employer are otherwise deductible. I guess the key point to note is that it's substantially unchanged. So the final ruling is substantially unchanged from the draft ruling issued back in 2019, and the draft ruling issued back in 2017 has been withdrawn. So basically, we're now left with taxation ruling 2021/1 applying to transport expenses on a go-forward basis. The general principles, look, really haven't changed all that much. The only sort of significant change has been in relation to employees who transit through like an airport or something like that to go to a remote work place. So the general principles that still apply are that If the travel is within the duties of employment, then it's more likely to be deductible, whereas if it relates to the personal circumstances of the employee, then that's less likely to be deductible. You need to have a look at the practical demands of carrying out your work duties. Does it require you to travel to a different location from where you live in order to perform your work functions? And that will, again, support the fact that those sorts of expenses are deductible. Deductible travel will generally be more likely where the employer asks for the travel to be undertaken by the employee rather than the employee choosing to do that. Where the travel occurs on work time, again, is an indicator that it's deductible expenses. And finally, when in the course of traveling, the employee is operating under the direction and control of the employer. So that might be that employer policies apply to that employee at that point in time when they're traveling. So some of the examples that come out in the ruling around when transport expenses aren't deductible, as you'd expect, the ordinary travel between work and between home and a regular place of work. Travel between home and a distant regular place of work. So this draws out the requirement or the factor that it doesn't matter how far away you are from work. If you live in Melbourne and you choose to work in Sydney, notwithstanding the fact that it's a long way away, that's still not deductible home to work travel. Also not deductible is travel from home to different regular places of work. So the example given is someone who works in a particular location on Monday and Tuesday, and then for the rest of the week works in a different store for that employer. So notwithstanding it's not the same place of work, they are both regular places of work, and therefore the travel expenses are not deductible. Travel from home to a transit point. So this is going back to the John Holland case that started all of this kerfuffle around transport expenses. So traveling from home to a transit point, for example, to an airport where the employee then picks up say a charter flight to go off to the work site or the mining site somewhere, that travel from home to the transit point is not deductible. Travel between home and a regular place of work when on standby, where the duties commence at the place of work. So the fact that someone's at home, they're on standby, they get called up and told, hey, you need to come into the office, that is still home to work travel, which is not deductible. And similarly, where the employee's working at home for convenience purposes, if they're required to attend the regular place of work, to attend the office, and then that's still not deductible travel. So what expenses are deductible? So travel between work locations, so between two different work locations is deductible expenditure. Travel to an alternative work location that requires overnight travel. So for example, if I'm required to go down and catch up with Ben and meet a client down in Melbourne, then that's travel to an alternative work location. We meet with the client, I stay overnight. That's all deductible transport expenses. I mentioned above about the travel from home to the transit point not being deductible. Once you're at the transit point and then you're transporting to the work location, that is deductible expenditure. So from the airport to the mining work site is deductible expenditure. Travel between home and a regular place of work when on standby, where the duties substantially commenced at home. So this is, again, a little bit of a judgment call around this. And some of the examples given by the ATO is someone perhaps in IT who is called up, tries to solve a problem while working at home, but in the end needs to go into the office to deal with a hardware issue. So in that example, then the transport expenses from home to the regular place of work can be deductible. And finally, where you're transporting bulky equipment, and that's always been the case, if there's a requirement to move that sort of stuff around, then transport expenses in those circumstances are deductible as well. The ATO has split out the sorts of expenses for people moving around between transport expenses and other traveling expenses, so things like accommodation, meals, and other incidentals. And what they're trying to do here in this draft ruling is to identify instances perhaps where an employee has been provided with an allowance, and to determine whether that allowance is a travel allowance, which might be paid to an employee who's traveling in the course of performing their work for relatively short periods, which would be deductible, any expenses related to that travel allowance or that travel to that location, versus a living away from home allowance, which is generally going to be paid, as Stephanie mentioned before, where someone is spending a longer period of time, but not permanently moving to a different location. Now, the two rulings, so this draft ruling, and once it's released in a final form, is intended to be read in conjunction with the ruling on transport expenses. Although it's interesting to note that it's possible to have different outcomes. So say, for example, where you might be traveling for work, but the place that you're staying at is maybe a holiday home, for example. And so there might be some different outcomes where the transport expenses are deductible, but say the accommodation expenses are not. This draft ruling 2021 D1 for travelling expenses replaces the 2017 draft ruling as it applies to travelling expenses. The general principles are kind of similar to the transport expenses. Is the travel required because of the employee's personal circumstances? Those sorts of things are less likely to be deductible. Is the employee living at a location? So this, we're looking at the length of time spent in the location, where the family and friends and all their really close ties are, to help us determine where the employee's home is and where is their separate work location. Has the employee relocated from their usual place of residence, and coming to the conclusion that, well, when you're traveling from work, then generally those traveling expenses are going to be deductible. So in addition to the draft ruling, the ATO has released a practical compliance guide, and this guide is providing insights as to when the ATO is going to apply compliance resources to looking at situations between when an employee's paid an allowance, whether that allowance is something that should be subject to income tax and PAYG withholding, and any deductions for traveling on work expenses claimed by the employee in their own tax return, versus the case where someone is living away from home, in which case the allowance would be subject to FBT. The practical compliance guide really takes us back to the dawn of time. So we had moved away in the draft rulings that came out. I moved away from this idea of 21 days being a rule of thumb as to when someone's traveling for work. So anything up to 21 days was generally viewed as traveling for work, and anything over 21 days was generally viewed as living away from home. Whilst that had been not spoken about in the earlier draft rulings, it's actually come back in the practical compliance guideline. The additional feature that's now been added to that is the idea that not only do you need to look at the particular period of time in that location, so whether it's more or less than 21 days, but if the employee is going back to that location frequently during the year, then you actually need to aggregate all of the time that is spent in the same location during the FBT year. And if it's more than 90 days, then that suggests that they are not traveling for work and potentially are living away from home. Important to note with this compliance guidelines that it doesn't apply to employees who are fly in, fly out, or drive in, drive out. The intention is the employee would return to their normal residence when the period away ends. So again, it's fairly well understood concepts, but again, we wait for the ATO to issue a final ruling. We're not expecting the final ruling to change too much from the draft ruling. I think everyone that's been associated with this is a bit over making submissions. They're regularly ignored. So we're left with what we expect the final ruling to be very similar to the draft ruling that has just been released. I'm just going to touch on now just some miscellaneous ATO guidance, and this is some rulings and the like that we've seen come out in the last 12 months. And really what this is just doing, it's kind of reminding us of some of the exemptions that are available in the FBT rules that Steph touched on, and this is bringing it to life in some practical examples. So electric bikes, so there is an exemption if an electric bike is used by an employee to travel between home and work, and various salary packaging companies have put together a program around this. And so this is the use of a bike rather than the employee being given property, being given the bike. It's just the use of a bike that's owned by someone else. And because it's a motor vehicle but not a car, then the exemption for home to work travel is available. Again, that bike can't be used for a lot of private travel on the weekends. It's really meant to be used only for home to work travel during the week. As Steph mentioned, there's potential to reduce the FBT liability for cars that are provided to staff, particularly where they're either doing a lot of business travel or perhaps not using the car much at all. And one of the problems have been for employers, it's actually tracking the use of that car. And a lot of providers out there are creating smart technological solutions that allows electronic logbooks to be created, and most of those or many of those providers then approach the ATO to get a sign off on their particular piece of technology and to ensure that that is an acceptable logbook for FBT purposes. And the smart track booking system is an example of that. Additionally, there's a class ruling for Adelaide Airport car parking facilities, and this is designed for employees, maybe fly in, fly out employees who would drive and park at the airport, leave their car there, and then head off to a work location that's outside of Adelaide. There is an exemption that's available for car parking if certain conditions are met and that sort of thing. And the key one there is that the car park's actually not located near where the employee usually works. So it's for, as I mentioned, perhaps fly in, fly out workers that are attending somewhere else. There is an exemption that's available for that sort of car parking facility. The ATO has actually gone to print on a question that was raised around employee contributions. Again, as Steph mentioned, that the FBT taxable value can be reduced where an employee makes a post-tax contribution towards the value of the benefit that's been provided to them. Now, the legislation isn't clear around when that post-tax contribution has been made, and we've always taken the view that you can make it after the end of the FBT year, but generally provided it's made before the lodgement of the FBT return, because you need to make some disclosures in the FBT return. And so this class ruling confirms that that is acceptable. We've also seen quite a number of health services, so work-related health services being offered by employers to their employees, and a lot of health service providers have come up with packages that they're looking to sell to employers. And this is really about trying to improve the overall well-being and ensure the wellness of their staff members. And so there are a range of exemptions which are available for things like medical examinations, screenings, preventative healthcare and counselling. And this class ruling is just an example of those sorts of exempt services that can be provided to employees. Finally, public bus transport. So there is an exemption that's available for travelling on a bus, on a public bus, where you're travelling between home and work. Again, it sort of falls back into that exemption that Steph mentioned before around using a motor vehicle that's not a car to travel only from home to work. And this is an example of taking advantage of that exemption that's available for those sorts of residual fringe benefits. And there's a program that is offered by a salary packaging provider to provide exempt travel on a bus. Unfortunately for us here in Sydney, things like Opal cards aren't falling within that exemption, so we can't use it, but certainly in a number of other cities, this is available. There are a couple of measures that were announced in the budget. Some of those are yet to be implemented, but one of them has already been enacted, and that's to expand the small business concessions for companies with aggregated turnover of less than 50 million. So previously it was less than 10 million, that's been increased to 50 million. And what this allows for is a larger number of small businesses to avail themselves of exemptions for car parking. So that's car parking on the business premises is not subject to FBT. And also for providing multiple work-related electronic devices to employees. So ordinarily, if you're not a small business, you can only provide one type of electronic device to your employee each year. But if you're a small business, you can provide multiple ones. It probably doesn't allow you to provide 50 iPads to your employees because it still needs to be used primarily in work purposes, and there might be questions raised on the use of the 48th, 49th and 50th iPad. But nevertheless, if you want to provide your employees with a couple of different electronic devices for use during the year, a small business can do that. This exemption applies from the 1st of April 2021, so for the FBT year we're about to enter. The government also announced some exemptions, both on FBT, as well as also looking to change some of the income tax deductions that are available for employees where they're retraining or reskilling. The technical problem was that ordinarily, if someone is training or getting skilled in their current income earning activities, so something that relates to what they're currently doing, that sort of expense would be otherwise deductible. But if it's something that doesn't relate to what they're doing, then it's actually not otherwise deductible. So potentially it would be subject to FBT if the employer provided to that. And one of the key ones that had been mentioned, is that employers might be looking to make someone redundant because they no longer need them, but they're actually a really good employee, so maybe they can be retrained to do something completely different. And so the proposed FBT exemption, which isn't law yet, but is intended to apply back to when it was announced in the budget in 2020, is to provide an FBT exemption for reskilling and retraining skills, which don't relate to what the employee is currently doing. Finally, the budget also announced a desire, really it's a desire because it relies on the ATO coming to the party, but to allow employers to use alternative corporate records for FBT. So one of the problems that's always been flagged around FBT is it's just so difficult for employers to comply with because of the record keeping and other documentation requirements. So government is trying to think about ways that employers can comply more easily by looking at alternate corporate records that might be already in existence. Problem is, I'm not sure what sort of records would allow you to get over the evidentiary burden for a lot of the things that people provide, expense payments and the like. So look, we're waiting on the ATO to provide a little bit more guidance around what sort of records it might see as being likely, and then to feed that information back to the ATO. But unfortunately, I'm not holding my breath for a complete alleviation of the onerous record keeping requirements. So apologies to everyone for that. Finally, just wanted to touch on some comments that the ATO has made around the tax gap. So the ATO over recent years has spent a lot of time in a range of taxes trying to quantify what it estimates the tax gap is. So what it thinks employers should be paying in terms of FBT versus what it's actually getting in the door. And the estimated tax gap in the 2017-18 year is approximately $1 billion in the ATO's eyes, and that represents about 21% of the total FBT liability. So a relatively large chunk of FBT potential revenue is not being received by the ATO. Now the ATO, by their own admission, make a whole bunch of assumptions around what they think it should be. So this is a very pie in the sky sort of figure, but nevertheless, it's important because the ATO looks at these numbers and then looks to apply compliance resources and education to try and narrow that gap. Really what the ATO is saying here is what they think is that it's more about employers not participating in the FBT system when they should be. It's less about employers not paying, who are already lodging an FBT return, not paying the right amount of FBT. It's probably more focused at employers who just aren't lodging FBT returns at all when they should be. And the ATO is thinking that the main reason is just lack of knowledge around this. So what's the ATO doing? So they're going to conduct a bunch of risk-based audits and reviews. So they have access to a whole range of data. And car fringe benefits is a classic example where the ATO looks at registration information looks at, has the car been registered in the name of a company, and has that company then filed an FBT return? And if not, why not? And that might suggest that that company is worth the ATO's effort to have a little bit of a look at, and it might be fine. It might be a business use car. The operating cost might be nil because it's 100% business use, but the ATO is going to use that sort of data to work out whether they should be taking a closer look. Strangely, the ATO has also flagged that there are instances where employers are including a reportable fringe benefit amount on a payment summary, but not actually filing an FBT return. So it's a little bit of a strange outcome, and the ATO sort of, not surprisingly, examining those sorts of scenarios. So the ATO is definitely putting more money into compliance, and as I mentioned, they're putting more money into educating employers around things like car fringe benefits, where there really is a significant gap, and where the ATO thinks that they're likely to missing out on FBT. So that brings me to the end of the presentation side of things. We've had a bunch of really interesting questions come in both before the session started and since we've been underway. And look, we do have just under 20 minutes to answer some of those questions. So I might just cover off on some of those now. Apologies if we don't get to your particular question. We have had quite a few. And there are also some questions that are going to have quite specific details that make it a little bit challenging to answer in this sort of forum. But just covering off on a few of those questions that have come through. There was a question around the provision of equipment to employees, and what if the written down value of the equipment is zero and you give that equipment to employees? Look, just need to be aware that there's actually a slight difference between the accounting written down value and the value to the employee. So if you're giving your employees some, a chair or something like that, and you might have written it down to zero because it's got no accounting value to you, the FBT rules don't necessarily follow that. You need to have a look at what's the market value. What would the employee have to pay if they wanted to get that chair? And it may be that it's much less than what it cost you, but there may still be a value to that. If they had to buy it on eBay, for example, and that's the sort of analysis that you need to do. But what you might find is that, notwithstanding that might be a relatively expensive piece of equipment when you bought it, if the value at the time you give it to the employee has dropped significantly and it's less than $300, then an exemption might be available under the otherwise deductible rule for that instance. There was a question around, to just confirm, look, if you actually reimburse equipment that costs more than $500, yes, FBT will apply. As Steph mentioned, the otherwise deductible rule assumes that the employee would be entitled to a once only deduction. And what this means is that the value of the item or the reimbursement needs to be less than $300, because that would be something the employee would be able to claim a deduction in their own tax return for, a once-off deduction if it's less than $300. If it's more than that, then what the employee should be doing in their own tax return would be to amortize or depreciate that equipment over a period of time. And because that's not a once-only deduction, something that's, say, more than $500 would not get you out of FBT. So you really need to think about the value of what you're providing to your employees. There was also a question around an allowance. If you gave your employees a $40 per week living away, sorry, not a living away from home allowance, but a working from home allowance. So just gave them $40 a week to help cover the costs of them working from home. That's actually not a fringe benefit. So the only allowance that is a fringe benefit is a living away from home allowance. Any other time you give employees cash and you're not asking them to substantiate expenditure, or you're not reimbursing something they've already incurred, that's actually an allowance that's subject to PAYG withholding, should be reported as such through the payment summary. And if there are deductible expenses, the employee should be claiming tax deductions in their own return. So just need to be careful around those sorts of allowance. There was a question around loaning equipment to employees and the declarations that are required in that instance. If you're loaning equipment to employees so that it's still your company equipment and the employees are just allowed to use it, that's not an expense payment fringe benefit because it's not a liability they've got, nor is it a property benefit because you still own it. It's just the use of the equipment. So it's a residual fringe benefit. When you're looking at declarations and the like, it's the declarations that are relevant for a residual fringe benefit where you're just loaning equipment to the employee. We had a question around living away from home and employees who live at home with their parents, so they've never moved out, and whether they can receive a living away from, or whether they can be regarded as living away from home. Look, unfortunately, the ATO guidance on this is no, and the reason being is that you need to have a lease or license to a property that you leave and then move to a second location where you're kind of living away from home. The ATO's view around where someone's living at home with their parents is that they don't have the requisite license or lease over the property, so it's unlikely that they can satisfy that. Just a little bit of a challenge there. Yeah, maybe enter into a rent agreement or something like that, but it probably needs to be a little bit more than just paying board or the like in that scenario. There was a question around employees of staff, children of staff who are attending a homework centre outside of normal hours. Those sorts of things do have the potential to give rise to FBT. It comes back down to the point of, would the employee have to pay for that themselves? If the employer didn't provide it, is it something they would have to pay for? If it's not something they would have to pay for because it would be free for other people, then probably not FBT. But if they would have had to pay for it, but the employer is just providing it to them, either because the employer is paying for the a third party to come in to provide it, then that sort of thing is likely to result in FBT. But what you might be able to do is look at how many times a year was that provided to the employee, and maybe the minor and infrequent exemption could apply in that situation. There's a question around loans, and when FBT applies to loans. So if you provide a loan to an employee, the otherwise deductible rule can apply to that. So if you give the employee an interest-free loan and they use those loans funds for a deductible purpose, so it might be to buy shares in a company that's going to pay dividends, or perhaps to buy an investment property that's going to give them rent, you don't actually need to charge interest on that loan. The otherwise deductible rule will apply effectively, and so an interest-free loan where those loans fund are being used for deductible purposes doesn't give rise to FBT. Of course, if you provide them with a loan and they use it to purchase their main residence, for example, then absolutely that could give rise to FBT if that's like a nil interest loan provided to the employee. There was probably the final question I'll just pick up on, given that we're kind of running close to time, was just around the minor and infrequent and the $300 limit. So for minor and infrequent to apply, the cost of the particular item must be less than $300. So it's the particular item. So you can provide multiple items during the year that are each less than $300, but collectively or in aggregate exceed $300. That's okay. You just need to make sure that those aren't associated benefits that provided at the same time, and you're just trying to artificially split the price out between two items that are each less than $300. Generally, though, I would be getting a little bit nervous if you're providing multiple items to an employee during a year, and in aggregate they exceed about $1,000 worth. Although there's nothing specific in the legislation, certainly our experience with the ATO that those sorts of things, the ATO is likely to spend a little bit more time looking at, because they take a view that you are providing something of substantial value to the employee, and minor and infrequent is really designed to provide an exemption where the employee's not being provided something with much of value. So just be careful. The more times you provide things to employees during the year, perhaps the greater the risk around that. So look, that probably covers off the questions there. If we didn't get to your particular question, we'll look to touch base with you after the session and have a chat to you around that. But again, appreciate your time, and I'll hand back to Ben to wrap us up.
Thank you, James. That was fantastic. I know how difficult it can be to talk about these things for such a long time and also deal with questions on the fly. So I think that's really well done. I think all that really remains is for me to just remind you that there'll be a recording available of the session. Should you want to access it, we'll also send around the slides that we've used. I'd really like to take a second to thank James and Nadine and Steph for the time they've been to preparing this session and the delivery of it as well. I mentioned earlier, James is in Sydney, the rest of us here in Melbourne. You can reach out to any of us. We can direct you to the right team person. We've got people doing this work all over the country, obviously, so feel free to reach out to any of us if you do have any questions at all. And I would also like to invite you to the next in our series of Working Australia webinars. At this stage, that certainly will happen on Tuesday, the 20th of April. At this stage, we are looking to do a further immigration update at that time. I know the last session we did was immigration focused to some degree, but the landscape changes pretty quickly. That being said, what we're going to do is take feedback from this session and understand what people want to hear from us on before we lock in for sure what the next Working Australia webinar session might be. So expect to see an update and invites to that one over the course of the next few days. And I think that's us. So thank you for taking the time to listen and to attend. As I said, any questions at all, anything you want to know more on, you know where we are, and we'd really love to help. So with that, I'll wrap us up. Thank you, guys.